Hi there, Adrian here, mortgage broker based in Sydney. On this channel we talk about all things lending, finance and investments. And on this video we're going to discuss self-managed super fund, especially SMSF home loans. Okay, so this is a product that's changed quite significantly over the last 3 to 5 years. So in the past, before the Banking Royal Commission, a lot of the banks, like your Commonwealth Bank, your Westpac, your St George, your AMP banks, did do a lot of self-managed super fund lending. All right, the rates weren't that great. They were sitting around your 4 to 5%, and that's obviously 5 years ago. And the majority of the better products that we were using was under the Westpac group, so under Westpac and St George. All right. Now, the same policies that they had back then are the same policies that the current lenders have right now. So essentially what you do is now bear in mind this is not financial advice. You've got to speak with your accountant or financial planner, so just use this as a roadmap. And I'll use myself personally as an example on what's going to happen. All right, so when you talk about self-managed super funds, the majority of the time, the minimum balance to set up a fund for it to be cost effective is between $150,000 to $200,000. Because one, you've got fees for setting up the SMSF, and two, you've got annual reviews that need to be done as far as an audit goes to maintain your compliance of the SMSF. So yes, you can set up SMSFs that are a lot smaller as far as balance goes, but the fees erode a lot away from that. So unless most people don't set up an SMSF unless it's over 200,000. Now, me personally, what I'm going to be doing is over the next kind of 18 to 24 months, I'm going to do a non-concessional contribution. So I haven't been putting a whole lot of money into super the last 3 years. Same goes for my wife. So we're going to do 3 lots of 50 grand each into super. That also counts as a tax deduction. We're going to chuck it into super, and then we're going to convert it into an SMSF with a balance over 300,000 total. Then what we're going to do is we're going to go and use that to fund 1 or 2 investment property purchases, and the main properties that I'm looking for, because the rates are slightly higher in the SMSF space as far as banks go, I'm going to be looking for properties that are over 6% rental yield. So the ones like your duplexes, your triplexes, your house and granny flats at the back, or small unit blocks, or just going into like a regional area, or the lower cost kind of cities like your Perth or your Adelaide, or maybe a Tasmania, all right, or a regional town that's quite a large town. So that's essentially what we're going to do ourselves. Now, what happened about 3 to 5 years ago is that it's called a single recourse loan. A lot of the banks got grilled on why they were setting up all these SMSFs and then putting all of the assets in the SMSF into one investment property. Now, a lot of these rules back then are different to what's happening now. So what was happening was that, let's say you've got a 200 grand balance, people are putting the whole balance using the deposit and to fund the stamp duty costs and everything, and then nothing was being left in the fund. So now it's a little bit different. Most lenders make sure that you have minimum 10% left in the SMSF to maintain the liquidity in the fund, also to account for all your fees and maintaining the fund as well. So you can't use all of your balance with the majority of lenders to go ahead and fund your investment property. So normally the step-by-step process is you go to your financial planner or accountant, and only a portion of accountants now can set up SMSF because it is, higher risk, and they need further training compared to 5 years ago. So unless they're doing a lot of it, a lot of accountants don't, and they just refer out to a financial planner. Now, normally, depending on how complex the super fund is, it can be anywhere from about $3,000 to $6,000, depending on the total cost. And then, depending on how complex your structure is, you can have annual fees in excess of, $500, $1,000, $1,500, and for the more complex structures, over $2,000 per year in annual fees for the audit to maintain the compliance on the fund. Now let's talk about lenders. So after all these changes happened and ASIC and APRA came into the industry and told the banks that you're doing a lot of these high risk loans, a lot of the lenders chose to discontinue their products. So what they've essentially done is any product that they've got currently on their books is aged. And then what they've done is they've jacked up the interest rates on those products. So you've got a big bulk of old loans, SMSF, in the likes of Commonwealth Bank, Westpac, and St George, that are sitting on quite high rates, 5.5, 6.5% interest rates. And then you had lenders like a Latrobe. Latrobe is a non-conforming bank. They came to the party very early after a lot of these changes happened. So you had all these lenders drop out within pretty much a 12 to 18 month period. And then Latrobe picked up a lot of the excess in that market. So did Liberty. And then over time, certain other products have come onto the market and taken away, some of the market share in that space. So some of the better lenders with the lower rates, with the better products that we're sourcing SMSF loans through at the moment is the likes of Mortgage Mart and First Mac. So they're the main ones. And First Mac was one of the main ones that came out recently with, a variable rate at 3.99%, which is pretty unheard of in the SMSF space because a lot of the time the interest rates are much higher. So really the main thing you've got to understand is if you go into this kind of product, there are 50 other banks to refinance. Most of the time, if you take out that product, it sits there for life. After you account for refinance costs and the difference in interest rate and knowing that there's not a lot of other products available, you have to understand that really if you're looking at this kind of strategy and going for a really good growth property with low cash flow, if you're not putting large amounts of money into the fund as far as contributions go to cover the shortfall, probably not the best strategy to use as far as SMSF lending is concerned. So as far as me personally goes, and I only really talk about what I'm personally going to do, I want to make sure that the property is self-sufficient. I want to make sure that even if rates go up 1 or 2%, that it's covering the majority of the costs. And, that's kind of my goal with this. And the reason why I'm going down this path compared to investing in shares for the long term is the leverage aspect. So, you can get leverage up to 80% LVR with these products. But the key thing is it's very different from a normal home loan. So a normal home loan, all of your income, so your base income, your overtime, your commissions, your bonus, all of that is accounted for as far as your borrowing power for a normal residential home loan. But for an SMSF, it's a little bit different. So what they do is they look at your contribution to super. So normally it tells you in your contract or on your pay slip. And most of the time it's 9.5%. So if you've got husband and wife, both putting money into the account, and their total income combined is 200,000, then only 9.5% of that money is going into the super fund. So then that 9.5%, which equals $19,000 in this example, you would add that plus the rental yield that you're going to get from the property, and then that's used to decide your borrowing power. So you're not using the full 200k income that you've got coming in, only the super contributions. All right, and if you're a public servant on 15%, obviously that's going to help you a lot more as far as servicing goes in an SMSF space. Or if you've got a plan in place where you're doing larger contributions per year, as long as you can show that you've been doing that over a 12-month period, most lenders will accept that. So up to I think the non-concessional cap, and don't call me on this, but I think the non-concessional cap is 50,000 a year. So always make sure you check that with your accountant or your financial planner. But if you are already putting larger amounts into super per year, you can potentially use that to increase your borrowing power in the SMSF space. Yeah, so key thing is you need to understand, the product selection has changed. The interest rates are slightly higher than residential. How you work out your borrowing power is different. How you work out how much money you've got in the fund and how much you need to leave in the fund changes from a normal resi purchase to an SMSF purchase. And then making sure that you understand, the lenders that you select them a lot more longer term. You're not moving lenders every kind of 2-3 years like in the residential space. You do have to be comfortable with leaving it with that lender long term. All right, now I'm personally doing it myself over the next kind of 18 to 24 months. So hopefully this video has added a lot of value to you. And if you like the video, hit that like button, hit the subscribe button so you can see the next videos. Leave me a comment and we'll see you on the next video. Hope that you've enjoyed this one. Have a great day. All right, bye.